I'm going to start out with a business update and kind of go over some stuff that's changed with businesses, and then go into individual updates. And then if we have time left at the end, I'm going to go over some of the stuff that the Biden administration has been, some stuff that's already been passed, some stuff that's halfway there, but probably not going to be in its final form at the moment. But we can kind of go over some of that just to give you some heads up of what might be on the way if we have time to get there on that part. Throughout the whole thing, if you have any questions, feel free to just raise your hand. I feel like that's the way you guys are going to, learn and get what y'all want to know and get the most out of this anyways. The good thing about this year, and I don't know how many of you guys have came to the past couple of years, but the past couple of years with COVID and everything that's been going on, there's been massive changes to everything. And so we have all kinds of new things with PPP loans and the employee retention credits and all these different things that were enacted to help people get through some, the tough times that they may have experienced from having shutdowns and whatnot. And so there was tons of changes. This year, luckily, going into 2021 and 2022, there hasn't been as many changes. So some of what we're going to be talking about is going to be still talking about some of those provisions, those COVID provisions, like the employee retention credit and stuff like that, but more talking about kind of what has happened with it and ways that you can still take advantage of some of these items that are out there, even though it might be looking back at 2020 and 2021. So let's start with the business update. There are a few new things this year for 2020. We're talking about the 2021 tax return. And on this one in particular, it is in effect for 2021 and 2022. We'll wait till he closes the door. There we go. That's better. This one's going to be in effect for 2021 and 2022. And so typically when you have business meals, you can deduct 50% of those on your tax return. For 2021 and 2022, you're going to be able to deduct you're going to be able to deduct up to 100% of it when it's purchased from a restaurant. And so there's a lot of language I put on here about how they define what a restaurant is. But basically, if it's somewhere where you're going to be dining in, taking out, or even like a food cart or something like that, it's going to be considered a restaurant. You can take 100% of those meals as a deduction. Things that you can't are if you're getting groceries or something like that and you're bringing that in and you're making a meal, or you're getting beer, wine, liquor store, drugstore, kind of vending machines, those are still going to be subject to the old rules. But anything you had coming in from a restaurant, either taking clients there or bringing it in for your employees, all that's going to be 100% for 2021 and 2022.
So we have to include marketing in that, right?
Yeah, go ahead. Why not? If it's from a restaurant, do it. So net operating losses. So basically, if your business has a net loss for a year, you get to, in 2018, 2019, and 2020, there were special rules that allowed you to take that loss and apply it back to your previous 5 tax years if you had income in those years, and use it to offset some of that income and get potential refunds back. You can still do that. So if you had a 2020 tax return, or 2020, 2018, 2019 tax return where you had a loss and you haven't, and you think maybe in a prior return before that you had income, make sure you're telling your CPA, I want to see if I can carry that back and get a refund on that type of item. What's changing this year, starting in 2021, we're going back to the official rules. So those 2018 through 2020 were kind of temporary rules, giving people who had, especially for that 2020 year of COVID, had losses, allowing them to go ahead and take advantage of that and maybe get some cash flows from carrying that back to prior years. For 2021, they're taking that away. You're not going to be able to carry it back anymore. And then when you carry that loss forward to the next year, you can only offset 80% of that taxable income the next year, and you kind of keep carrying it forward until you use it all. And so that's kind of a negative of changing, going back to those normal rules. CARES Act payroll tax deferral. So during 2020, there was a special provision that allowed you to defer paying the employer side of your Social Security taxes. I don't know of a lot of our clients that actually did it, but if any of your business did do that, just wanted to kind of show the due dates for those. So you were allowed to defer it for 2020, but you were going to have to eventually pay that amount back. So we told a lot of our clients, unless you really, really need to, we don't recommend doing this because you're just pushing it out farther, and most likely you don't want to have cash flow problems going forward in the future. But if you did, they're taking 50% of that is going to be was due December 31st, 2021, and the other 50% of what you deferred is going to be due at the end of this year. So, who all in here has heard of the employee retention credit? So, okay, so this is going to be new to a lot of you guys. So, this is effective for the 2020 tax year, all 4 quarters, and for 3 quarters of 2021. And so it's a refundable credit that you get to claim on your payroll tax return, so your quarterly 941s. And it's based on the qualified wages that you pay to your employees. And so who's eligible for it? It's basically, there's 2 different ways to be eligible. Either you're fully or partially suspended operations, which, besides restaurants and some other stuff around here, there wasn't a lot that were fully shut down. This first kind of qualification, being shut down by governmental orders, is a little bit harder to qualify for. It's a bit of a gray area, and I think, if this is what you're trying to say, I can take the credit because of this one, I would definitely consult with someone, with a CPA or your attorney, to make sure that that's correct before doing this. The 2 that are kind of like bright line tests, and you can easily tell if you qualify for, are these next ones. So for 2020, if you want to take the credit for any of the quarters in 2020, you basically look at your gross receipts for 2020, and so you look for each quarter. So I'm going to use the first quarter of 2020 as an example. So if your first quarter 2020 gross receipts, we'll say, were $100,000, and then you look back in 2019 and your gross receipts for the first quarter of 2019 were $250,000, let's say, then you had a greater than 50% reduction in your gross receipts when you're comparing 2020 back to 2019. And if that's the case for you, then you're eligible to take this credit for that quarter. And it works the same way for all the quarters in 2020. You will compare that same quarter back to the corresponding quarter in 2019. We'll get into what the credit looks like after that. I just kind of want to cover this, who's eligible for it first. For 2021, it's a little bit easier. You're going to be comparing the quarters in 2021 still back to 2019. And the reason they're doing that is they want to see, they're expecting in 2020 and 21, those would be the years that if COVID affected you, your gross receipts would have went down. And so you're comparing it back to 2019, a year before COVID was really affecting a lot of businesses. And for 2021, you just have to have a decline in gross receipts of 20% to be eligible for it. So it's a lot easier to, even if your business hasn't really been affected too much by COVID, it could just be, you have a 20% decrease in one of your quarters in 2021 to 2019, just the timing deal. You never know. So it's worth looking at those quarters. Look going back through your books if you have a ability to do that, and just kind of check and see if there's any quarters in 2021 when compared to 19 that your gross receipts are down. And I'm going to show you why it's worth the time to do that here in just a second. So the credit for 2020 is going to be, if you're eligible for it, so if you meet that test that we just kind of talked about for 2020, the 50% reduction in your gross receipts, when you're comparing those quarters, you can take a 50% credit on up to $10,000 per employee annually. So basically, per employee that you have, you can get up to $5,000 credit for them. It depends. You're going to be looking quarter by quarter basis. I'm not going to go into the full calculation of it. But say your whole 2020 was say you paid your employee $10,000 in that first quarter of 2020 when your gross receipts were down 50% from 19, you would be eligible to take a $5,000 credit for that employee, and that credit would be taken on your payroll returns. Now, if you didn't do that on your 941 originally, but you go back and look and say, hey, I should have taken that credit, you can go back and still amend those returns. There's still time right now to amend those returns, those payroll tax returns, and claim those credits. And it can be, it can add up and be in a substantial amount of money. And we've had a lot of clients that have gotten substantial credits off of this. For 2021, it's even bigger number. So it's easier to qualify for these 2021, and it's a bigger credit. So that $5,000 credit limit I was talking about for 2020, that's an annual limit per employee. So per employee, the most you could get for that employee is a $5,000 credit for the whole year. Even if you're doing the calculation each quarter, once you reach $10,000 on that employee, you can't include him anymore. But for 2021, you can do the same thing for every quarter. So you can look at those 10,000 wages for each quarter. So you can have, and you actually get to take a 70% credit. So you can have a $7,000 credit per employee per quarter. So up to $21,000 per employee if you happen to max it all out. So it's a big credit, and it's definitely worth looking if it's something that you would be eligible for. The credit remains at 70% right now. It's, like I said, it ended. It's just looking through the first 3 quarters. It was going to be all of 2021, but then when Joe Biden, that infrastructure bill came out, part of it was to stop this credit going forward as of September 30, 2021. So they made it to where it was just the first 3 quarters. Does anyone have any questions on that? This is one of the things that I've seen where clients weren't aware, and we were able to, if it just look and happen to find a quarter or two where their gross receipts were down in 2021 compared to 2019, and they were able to get some significant credits out of it. So I just want to make sure you guys were aware of that. I'm going to skip this one now just for time purposes. So this is going back to PPP loans. How many of you guys, did anyone get a PPP loan and go through that process? Go for some. And just kind of recapping some of that. Originally, when the PPP loan came out, on the tax returns, what they were saying was, yeah, you got the PPP loan and you got it forgiven, but the expenses that you paid with that PPP loan, we're not going to let you deduct those on your tax return. And so we did a lot of tax returns, when we were doing them for last year for the 2020 tax return early on in the year. That was the rule around January or something. That was what they were telling us. And so then about February, I think it was, I can't remember exactly when it was, they released something that said, no, never mind, we are going to let you deduct those expenses. And so luckily, all the expenses that you paid with the PPP loan are deductible. And there's procedures to file returns. If your CPA or whoever filed a return and they didn't take those expenses, you are eligible to take them, and there's ways to go back and correct that. This is just something to be aware of. If any of you guys have pass-through returns, like a partnership or an S-corp return, there's a new requirement that basically everyone's going to have to comply with. It's going to be, you usually get your form K1 from your pass-through, and you use that to report it on your individual return. Well, there's 2 new forms. They're only relevant if you have a foreign tax type of situation, if you're getting income or dividends or something like that from somewhere outside of the U.S. and you pay tax. There's a whole complicated tax system for that. But the IRS has decided no matter what, even if you have that situation or not, even if you might have that situation, your pass-through return is going to have to also file these new forms K2 and K3. And if you don't, there's a potential penalty for it. They're going to be lenient with the penalty for 2021, but just be aware that whoever your CPA is, that this is a form that needs to be on there, this K2 and K3. And if you have questions on it, you can always contact me. At the end of this slides, my email is going to be on there, and I'll make sure that you guys all have it. If y'all ever have any questions on anything, you feel free to email me. I'll answer back. I'm not going to charge you anything or anything like that. So that's really it for the business side of the update. So it's not as much changing as, as y'all are probably used to from the last couple of years. And, from my perspective, I'm very glad, very glad about that. And I think everybody needs a little bit of, just keeping it the same as it is for now and a little bit more normalcy going into it. So does anybody have questions on the business stuff before I start talking about the individual? Can y'all hear me good in the back? Okay. So these are just the brackets. I'm going to skip, this is for the single taxpayers, but I'm going to skip forward to the married filing jointly. And so y'all know, just kind of a refresher on this, the way the tax system works with your income on your individual return is you don't just look at, where your your total net income is and then look at the rate and that's what all of your income is taxed at. It's taxed progressively, kind of a bracket system. So the first $20,000 of your income is going to be taxed at 10%. The next $60,000 at this 12%, and as you go down, it kind of works like that. The thing I kind of wanted to point out on this slide is that you can see the difference from 2022 to 2021 on all of these numbers being about 3%. So they're increasing, the bracket's up by about 3% to where, you have to pay those increased rates as you go. But the last time I looked from 2021 to 2022, the inflation rate was about 7%. So it's not keeping up with that. So people are going to be paying more for goods and stuff like that, but their tax rates aren't getting increased by that same expected amount. So you might be getting people getting increased wages and stuff. A lot of employers are trying to keep up with the inflation and keep increasing, giving some boost on the wages and things like that. But the tax brackets aren't reflecting that same thing, so it's just something I wanted to point out that's annoying. So these are your capital gain tax rates. And so capital gain tax rates are if you sell something like stock or an investment or something like that and you've held it for over a year, you get a preferential tax rate. And so those preferential tax rates depend on what your overall income is. So say you sold a stock that you've held for 2 years and it was a gain of $10,000. If this doesn't work the same way as the income does, where you're paying your first amount at this rate and your next amount at this rate, it just looks at what your income is that year, and then that's the rate you're going to pay on all your capital gains that year. So if your net income, taxable income was $100,000 in 2021, and you had $10,000 of capital gains, you would pay 15% of tax on that $10,000, and then the rest of your income would be taxed at those other rates that we were talking about. So 0% for if you're married filing jointly and you make less than $80,000, your capital gains are going to be 0%. If you make between that 80 and to a 500,000, it's going to be 15%. 501,000 and over, then your capital gains are at 20%. This is your standard deductions. So what these are, basically, when you get to your net income, all your business income, your wages and everything like that, you get all your adjustments to it. And before we start looking at your itemized deductions like charitable contributions, medical expenses and mortgage interest, real estate taxes, those type of things, you have to compare the total of all your items like that, your medical expenses and all those things I just listed, and say those were $20,000, and then you compare it with what your standard deduction is, and you get to take the greater of that on your tax return against your income. And so 2 or 3 years ago, these used to be about half of what they are now. And so a couple of years ago, they raised them significantly. So if you're married filing jointly, you automatically get a $25,100 for 2021 standard deduction. And so most people, I think they said it was about 80% of people, I can't remember it's somewhere that 80 to 85% of people are going to fall into using the standard deduction, because you have to have a significant amount of contributions usually, or medical expenses, to overcome that $25,000 amount and start using your itemized deductions. Annual exclusion for gifts. So I'm not going to talk too much about this, but there is a potential tax that you have to pay on gifts, but you get to exclude the first $16,000, and this is for 2022. You get to exclude the first $16,000 of gifts per person that you gift it to. You get to exclude them from that whole gift tax system. That number is $15,000 in 2021. So it went up $1,000 from 2021 to 2022, which is pretty significant. It's about 6 or 7%. So that actually is keeping up with the inflation, and that's the reason why it did go up so much as well, is because it is indexed right there at the same rate as inflation is. And so that's just something to keep in mind. If you are worried about gift taxes or estate taxes, you can gift $16,000 for 2022 per person that you gift it to, and it gets excluded from that whole gift tax system. We won't go too much into the gift tax system because that could be a whole thing on its own.
Question, Greg.
Yes, ma'am.
If that happened to be the gift in a 401k, does that still apply?
If you gifted it out of your 401k,
Right.
it would still apply.
So it would not be taxable?
And not for there's two different systems we're talking about. If you gifted something out of your 401k to someone, you're asking if it would be taxable to that person? Or you're asking if it would be taxable for you?
To me.
It would not be taxable. There wouldn't be any taxable. You would just be, you would be, you're talking about getting that distribution out of your 401k. Yes, first that would come out to you, still taxable to you, and then you can make that gift. Yes, ma'am. So credits and deductions. This is something that's kind of new for 2021. It was here for 2020 as well. But if you do, or if you are one of the majority of people that are using the standard deduction, you can still get a little bit of benefit from your charitable contributions. Used to, you couldn't, because it would all be in your itemized deductions and you're not getting to use any of that. But now it's $300 if you're single, and up to $600 for those that are married filing jointly. You get to take that deduction straight off of your taxable income on page 1 before we consider your standard deduction. So that's something new, to make sure that you're getting that on your tax return if you have that. Also, previously you were kind of limited when you're looking at your gross income. They would limit how much of a charitable contribution you could even put on your itemized deductions, and it'd be limited to 60% of your income for that year. And for right now, for 2021, you can do up to 100% of it, which you don't see a ton of that, but it's an option now. So if you say your income was, your net income, your taxable income was, I'm trying to think of a number that would be easy to do, we'll just say $10,000, and you wanted to take a deduction on your Schedule A for medical deductions, you were only able to take up to $6,000, which is 60% of your income. That was all that you could use for that year, and everything else got carried forward. But now you could take up to the full $10,000 of your income for that year and put it on there. So some people that are doing, are using that planning, as a lot of high income people that are always, giving significant amounts, are kind of using this 2021 year. I might as well do more this year and just reduce my income all the way down to zero. So it's possible. Expanded child tax credit. This one's probably going to affect anybody in here who has children under the age of 17. So for 2021 only right now, there was a bill passed that expanded the amount of the credit. and it also provided that you got some of that up front. And so the credit increased from $2,000 to $3,000, and it's $3,600 for a child under 6, but for other child it went up to $3,000 per child that you have. And the age limit used to be 16, but for this year it's up to 17. For 2021 it was. And the full amount of it is refundable. And what that means is the credit can reduce your taxable income all the way down to 0, or your tax due all the way down to 0, but then you also can get a refund for any extra credit there is after that. But a lot of credits don't work that way. A lot of the credits will just reduce your tax down to 0, and that's all you can do with it. A refundable credit, you can actually get that money back from the government and get a refund for it. So the credit phases out. Basically, if you're single at $75,000, it starts to gross out after that. And if you're married filing jointly, it's $150,000 if you make that much. And anything over that, the credit starts to phase out, which just means get smaller over, I can't remember what kind of increments it is. So I think at $200,000 and then $400,000 if married filing jointly, then it's phased out completely. The thing that's going to be different about it this year on the tax returns is that part of what Biden wanted to do and what they did was they paid out this credit in advance. They started paying it out in July. And so a lot of people started getting payments directly from the IRS from July 2021 all the way through December 2021. And so a lot of the clients that I've seen, and myself, I got about half of what my credit was supposed to be for the year, so I already got that amount. And so what you do on the tax return is you figure what your total credit should have been, you reduce it by how much you already got, and then you get to claim that amount on your tax return. And so because of that, all the tax preparers are going to need to know how much that you got, and the IRS sent out some forms. I think it's a letter 6475 to everybody, and it lets you know how much they sent you. It's important to kind of check that letter and make sure that's what you actually got. And then also important to give that to your tax preparer so they can make sure and get that right for you, because it's a big credit this year for a lot of people. Does that one make sense to everybody? Because that one will probably it'll probably affect a lot of people. If it doesn't make sense to you, that's okay. I wouldn't make sense to me if I didn't have to do this every single day. So that was really it I had for the individual side of the update. So it's been about 40 minutes. So unless y'all have questions on those items, I'll go ahead and start talking about some of the stuff that's on Joe Biden's tax plan and where we're kind of at with that. Okay. So the infrastructure bill, this is the one that's already been passed. So this has been passed by the House and Senate, and it's passed into law. And it didn't have a ton of tax relevant items in it. It had a lot of stuff in it, $1.2 trillion worth of stuff in it, but not a lot that affects tax returns and tax planning and things like that. So the tax aspects of the bill, one of them I kind of already mentioned, that employee retention credit. Originally it was going to be for all quarters in 2021, but they decided it's only going to be for those first 3 quarters. That was one of the things. The other important thing it did on there is it's going to impose new reporting requirements for crypto assets. So, the major markets, basically anywhere that you could get crypto from or you did buy and transact crypto from, they're going to start requiring them and treating them kind of like brokers and having them send out some sort of documents to the IRS and as well to you to let you know how much gains or losses that you had off of transactions with your crypto. The crypto stuff is while we're talking about it, it's one of the top things the IRS are worried about now and trying to figure out ways to tax, because there's millions of people that have already one way or another transacted with Bitcoin or one of the other crypto assets, but there's only been it's in the tens of thousands of tax returns filed that show the crypto. So there's a big gap there, millions to 10,000 of people that have actually transacted with it, with people who have reported any of those transactions. And so the IRS is, there's tons of stuff they're doing right now to try to figure out ways to make sure people are reporting what they are. So I would say if you do have crypto stuff and you're transferring one asset for another, or you're actually transferring it for cash or anything like that, make sure that you are using a CPA or somebody that knows how to report it on there, because the IRS is not just turning the eye. They might not have said anything yet, but it's something that they are definitely going to be coming after. So I just want to mention that part. Let's see. A lot of the other ones are very specific tax credits related to very specific businesses, like highway-related taxes, super funds, and things like that, so we're not going to go into that. So that's the one that's already been passed. There's another bill called the Reconciliation Bill that has passed. It passed the House, but it has not passed in the Senate. And you probably heard about this in the news. And I'll just tell you now, it's not going to pass in the Senate as it currently is. It's definitely going to change some. In order for it to pass, every single Democrat in the Senate has to vote yes for it. Not a single one can go the other way. And there's a couple of senators, I think Joe Manchin and Kristen Sinema, that I've already said they don't like some of the provisions in there, and they're not going to pass it as it is. So what usually happens is the Senate creates their own, version with changes from what the House did, and they send that back to the House, and it kind of has to go back and forth until they both agree on one and they both pass it, and then it'll go to Joe Biden to vote into law. So just keep in mind that what we're about to cover is what the House passed, but it's likely to change. It could completely change, I don't know. But this is what the House has passed, and we'll see where it goes from there. Usually some of the items stay in there, or there might be the amounts get changed, but some of them will probably be completely gone as well. So there's some new credits and things to encourage the development of low-income housing. So there's a low-income housing credit that they're making, and then there's about 30 different credits that are all energy related to encourage renewable forms of energy over the typical oil and gas energies that we have. So there's solar and wind and a lot of different credits for both buying that type of stuff for your own property or being a business that is in the business of doing that stuff. There's a lot of incentives for that and credits in there. We talked about that child tax credit, the changes that were for 2021 only. Part of what's in the reconciliation bill is to make those changes to, I don't remember, I think they go through at least 6 more years is what I want to say is what they're going to do for it. So to just basically extend and modify those changes that were 2021. So all those increases that you were getting for the credits for kids would keep going instead of just ending for 2021. Because right now, 2022, we're going to be back to the normal child tax credit rules without this passing. Earned income tax credit, it's another credit for low-income households. They're going to make it easier to qualify for this. There's several changes to it in the bill. And then there's about 8 different incentives and credits that they're going to have to kind of expand how Obamacare and to make the premiums more affordable for low-income households. There's several different ways they're going to do that. I'm not going to go into all the specifics on them, but they are listed on here. Changes to SALT deduction limit. What the SALT is basically state and local taxes. So that's one of those items that you can do on your itemized deductions, what we were talking about earlier, when you compare your itemized versus the standard deduction. Right now, there's a limit on those state and local taxes, which for us, unless you have out-of-state tax returns or something like that, what that is really talking about is your real estate taxes that you're paying. And so for Texas, it's not usually a big deal for Texans, but for some people that are from states where there's high income tax rates and they're high income earners, they can be paying up to $50,000, $100,000 in income taxes for their state, and so they're not allowed to deduct that right now. They're only allowed to deduct up to $10,000. And so the current proposal is to raise the limit up to 80,000. But this is one of the things that a couple of the Democratic senators have already said that they don't support, and that it's very unlikely that this stays in there as it is, this survives in the Senate. A lot of this page, what it's going to be talking about is very high income and very high income, especially for the business. There's going to be a new, they put in a provision for a new minimum tax system but it's only for businesses with an average financial statement income of $1 billion. So I don't think anyone needs to worry about that. Good on that. And that's a lot of this on this page is going to be stuff like that. So has anyone heard of the net investment income tax or had that pop up on your tax return? So that's another thing for high income earners, and it's basically like an additional 3% tax that you pay on certain types of income that you have. So if you have like basically passive types of income that aren't from your business, like interest, rents, dividends, and things like that, in addition to your normal tax rate, you're paying an extra 3% tax on that. Well, the provision on here is going to take that and kind of expand it and make it where any pass-through income that you're getting, even your business that you actively are part of, is going to be subject to that 3%. But it's only for high income. I think it's for $500,000 of taxable income if you're married, filing joint, is what they're saying. This is another one that's not going to affect a ton of people. There's just going to they're just going to add a 5% surtax. So basically add 5% tax if you have adjusted gross income over 10 million, or 3% if you're over so you're 10 million. So for your 10 million to 25 million, you're going to have a 5% surtax, and if you have 25 million and over, that's going to be 8%, an extra 3% on everything on that. Again, I don't think most of us are going to have to worry about it. And if we do, good for you. God bless you. Retirement plan changes. Most of these are targeted as well for high income taxpayers or someone who has a large balance in their retirement account. So generally you won't be able to have annual additions to your plan if you have a balance in your retirement account greater than 10 million and your taxable income is greater than 450,000 married filing joint. So basically they're not letting you take advantage of the deductions you get by increasing it if you already have such a big balance in it and you're making that much. Same thing, there's going to be, currently once you reach a certain age, you have to take a required minimum distribution from certain retirement accounts. They're going to increase that significantly for those who have a large, like 10 million and over on their retirement accounts. I'm going to skip some of that. The corporate tax rate, they're wanting to take that from 21 to 28%, and that's another big one that Joe Manchin, I think, has said he doesn't agree with, so that could be something that changes. And that's all I had. Here's my information. There's my email, gregoryp@gmpcpa.com. And like I said, if y'all have questions on any of this, I don't know if y'all have access to these slides. I think so. I think Coleman sent something out, or he said y'all can access it on their website or something like that. If y'all ever looking at this and y'all have questions on any of it or anything like that, feel free to email me. I'd be happy to answer your questions. That's all I have.